Ladies and gentlemen, good day and welcome to MTAR Technologies Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Irfan Raeen from Orient Capital. Thank you, and over to you, sir.
Thank you, Nirav. Good morning, everyone. Myself, Irfan Raeen from Orient Capital. We are an investor relation advisor to the company. I hope that all of you and your families are safe and healthy. On behalf of MTAR Technologies Limited, I extend a warm welcome to all participants on Q4 and FY22 financial result discussion call. Today on a call, I am joined by Mr. Srinivas Reddy, sir, Managing Director and Promoter, Mr. Guneshwara Rao, Chief Financial Officer, and Ms. Srilekha Jasti, Manager, Strategy and Operations. I hope everyone had an opportunity to go through our investor deck and press release that we have uploaded on exchanges and on company's website. Before we begin with the call, I would like to give a short disclaimer that this call may contain some of the forward-looking statements which are completely based upon our beliefs, opinion, and expectation as of today. These statements are not a guarantee of our future performance and involve unforeseen risks and uncertainties. With this, I hand over the call to Srinivas Reddy, sir. Over to you, sir. Thank you.
Thank you, Irfan. Hello and good evening, good morning, everyone. Trust you and everyone are well and safe. Today on the call, I am joined by Guneshwara Rao Kushala, Chief Financial Officer, Mr. Srilekha Jasti, Senior Manager, Strategy and Operations, and we have Orient Capital as well, our investor relations partners. We have uploaded our updated investor deck and results highlights on the stock exchanges and company website. I hope everybody had an opportunity to go through the same. Thank you for making the time to join us today. I'm more than delighted and to share with all of you with regards to the initial guidance given by us. Starting in the year, beginning of the year, we had given a guidance of revenue growth of 20 to 25%. We had revised our guidance upwards to 30-35% during the last financial year. And I'm delighted to say that we have achieved, based on our guidance given, close to about 31% in revenues and EBITDA of close to 30%. That's what we had clearly mentioned in our last guidance call when we had mentioned about this. In spite of various disruptions, as we all are aware of COVID-19 and geopolitical concerns that we had during the year, especially during the fag end of the year. I'm extremely proud and as well as grateful for all our employees who relentlessly work with complete commitment and extraordinary efforts to make all this happen during these unprecedented times. Our CFO will be taking you through the financials in detail a little later on. However, I would like to give a brief overview on the various aspects of the business, just a summary of the entire sectorial areas, what we are dealing with. Our order book, which we had given a guidance of about 700 crores of closing order book, we are at about 648.8 crores as of March 31st. We obviously have to get one additional order of about 60 crores plus from nuclear power, which we are getting it in this quarter. We have already declared L1 on that. So we are close to what guidance we had given in the past. This order book comprises basically 25% of nuclear, 28% of space and defense, and we have about 45% in clean energy, and the rest are in various products that we are dealing with, close to about 9.56 crores, giving us a very healthy revenue visibility for the future as well. As far as the revenue contributions are concerned, we are looking at civil nuclear. We were at 45.72 crores in FY22, which is at 26%, and from space and defense 53.4 crores at 22%. And from clean energy, we are at 201 crores, which is at 64%. And from the products, we have done about 4% of the total revenue. So further to this, we are looking at a very strong order book closure even for the current year. We're looking at close to about 800 crores of order inflow during the guidance that we would like to give is we would receive at least about 800 to 850 crores of orders during the current financial year. And we might close at about 1,000 crores of order book by end of this year. So as far as the product portfolios are concerned, what's happening with our products, the development, the R&D innovations. As we mentioned earlier, we have been qualified for the roller screws and the first articles are being delivered in this quarter to DRDO. That's something which we are really proud of. It is a 100% import substitute, which is right now being imported from Railways of Sweden. We have also started developing the electromechanical actuators for which we have received orders of close to about 7.5 crores already. And that's under progress, which we'll be able to execute in this year. And we are expecting a lot more orders in these products as well. We are going to release the semi-cryo engine for higher payload of for the GSLV launch, which enhances the capacity to 4 tons. That's being released this year, mostly in the third quarter of this year. That's the first of the engines that's being manufactured in the country. And another good news is that we have already developed the bellows which we are importing for clean energy earlier from US. We have already developed those bellows and we started using it in our operations right now. So these are the things which we have done. And we are working on various other products as well, and systems and subsystems. Continuous R&D is going on. So that's been the forte of MTAR over the years. As far as the customers are concerned, the way we look at it, last year we were able to start commencing our association with Hitachi, Andrix, Bentel, WAM, ARD, DMD for valves. And we have a number of customers in the pipeline which are in very advanced stage who will join us in our customer basket this year. We're looking at IAI, which is the Israeli aerospace industry, is one of the largest. ELTA on the, one of the largest companies in Israel. Enercon from Germany for the windmill. Then we have the Bluebird Aerospace Systems, and we are also talking to a lot more customers based on our new capabilities that we have started working on in our new projects near Adibutla near the airport. As we had mentioned earlier, the idea of offset clauses and MSME advantages, which we had explained earlier, we are in the process of taking over the GP Aerospace, which will be a huge advantage for the company moving forward as well in dealing with a lot of MNC customers, and also having a advantage in terms of some of the domestic orders because of the MSME status. And that's where we are looking at, and we strongly feel that this acquisition will not only strengthen the capabilities in order to get orders as far as the MSME clauses are concerned, having certain advantages, and also working with certain OEMs who prefer to work with MSMEs on certain orders to get the MSME, the multiplier that they need for the offset clauses. Finally, I would like to, after a lot of review based on our annual operating plan and the way we look forward, we have always given a guidance which is very reasonable, and we have never given a guidance which we are not able to achieve till date. So for the current year, we really looked at it, and based on the healthy order book that what we have, we're looking at a revenue guidance as of now. We're looking at about 55 to 60% for FY23, which is actually a phenomenal effort if you're able to achieve that. But I would strongly feel that there should not be any kind of downside to this. And we would still maintain EBITDA guidance margins of about 30% with plus or minus 100 basis points. With this, I hand over the call to our CFO to take you through the financial highlights for Q4 and FY22 as well. Thank you.
Thank you, sir. Good morning, everyone, and a warm welcome to our earnings call. I will take you through the financial and operational highlights, post which we will open the floor for questions and answers. We have witnessed a strong growth which is in line with our projections this year. So FY22 versus FY21 overview I wanted to highlight now. MTAR, we have clocked an annual revenue of 322 crores with an YOY growth of 30.7%. We have posted an EBITDA of 94.4 crores with an YOY growth of 13.6%, and profit after tax is 60.9 crores with a growth of 32.1%. Our diluted EPS stands at 19.8 as against 17.0 FY21. Regarding Q4 22 and Q3 22, revenue from operations stood at 98.6 crores in Q4 FY22 as against 78.1 crore in Q3 FY22, which is 26.2% increase in quarter on quarter. EBITDA reported at 27.7 crores in Q4 FY22 as compared to 22.8 crore in Q3 FY22, which is a 21.4% increase in QOQ. Our profit before tax at 23.8 crore in Q4 FY22 as against 18.7 crore in Q3 FY22, which is also 27.1% increase over the previous quarter. Our profit after tax was 19.8 crore in Q4, 19.8 crore in Q4 as against 13.3 crore in Q3, which is 48.8% increase over QOQ. Our diluted EPS stands at 6.4 for Q4 FY22 as against 4.3 for Q3 FY22. And also I want to highlight other key ratios like ROC as on March 22 is at 14%. As against 19%, the main reason for decrease is because, as you all know, we are actually investing in capex at Adipatla unit for the revenue growth what Mr. Srinivas Reddy has informed earlier. So that is the reason. Otherwise, as far as the absolute numbers are concerned, we are increasing year over year. As far as our net working capital, which is 290 days, 299 days, as against 198 days. For the increase in working capital is because the average inventory of raw material is 88 days, which we are securing the material ahead of time because of the COVID-19 pandemic and also geopolitical concerns. So in order to avoid production stoppages, and we are procuring in advance so that there won't be any production stoppage and revenue growth. And the other big item in the working capital is the WIP, which is 121 days. So we manufacture the products based on the orders. So because of these WIP, which is higher in terms of the revenue growth. And the other big ticket item is a receivable, which is 167 days. As you all know, in the domestic customers, we are actually bound to the terms of the tender. So we can't change any terms of the tender. If at all we want to change, we will be out of the tender. So we have to follow the government organization tender conditions. And in case of a bloom, the net receivable is 45 days after reaching USA because of the the supply chain disruptions. Now it's taking 110 days of the revenue. So, but all our receivables are 90% current and no overdues are there, no bad debts are there. So we are planning to reduce our working capital. The absolute amount we wanted to reduce, but given the 50% extra revenue, 55 to 60% what our MD is saying, because the revenue increasing, we need to spend more revenue, more receivables, more inventory. But we will try to reduce the days, but absolute number may grow up. So to conclude, I would like to highlight that increase in revenue and the sustainable margins due to operating leverages, we will improve the return ratios for the company going forward. With this, I will open the floor for a discussion. Thank you all.
So shall we open the floor for questions? Thank you. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
My question. So just to understand your guidance in a better way, I mean, if you look at your order book, which is about 650 crores as of now, and you're guiding almost like 55% revenue growth, which is like 500 crore revenue next year. So when we look at your breakup, 288 crores is only from the Bloom part. So are we assuming this whole 288 crore will get executed this year? And if yes, then the remaining 220 crores will come from the nuclear and defense, which will imply some 200 crore worth of revenue. So, and generally last 2 years have been 100, 110 crores. So if you can help us better understand, this guidance breakup would be really helpful.
Absolutely, Nitin. This is something which is very encouraging for us. You're absolutely right. So when you're looking at domestic segment, we're looking at about other than the Yuma hot boxes, more or less. We're looking at 120 crores, 110 to 120 crores. But the major revenues are actually doubling up literally beyond 200 crores plus. That's a very good sign because we have that kind of order book that we're executing. As the CFO has said, we built a platform for that during the current year, the last year itself, in terms of work in progress to execute those orders. And the kind of orders we have already with us, we are in advanced stage of executing them and having all the raw material and various other aspects under control. So that's something which is growing literally 80 to 100% higher than the Bloom Yuma boxes for this year. Now, another thing is that 288 crores, what you mentioned, yes, it's being executed this year for sure, and that is as of December. So what guidance we have given of 55 to 60% is something which we are very confident of achieving it. And this 288 crores is as of December, and obviously the Bloom works under calendar year, and we work until March financial year. So we'll get further orders during the course of the year under various segments, either in sheet metal, which we already qualified for it now. We already have a $4 million order for the sheet metal as well. And we're also looking at the specialized assembly which we have sent for the fuel assemblies which we have sent for qualification. We're looking at a major upside for those assemblies, which is close to about $7 to $8 million. So a lot of additional products we are developing for Bloom, which we are indigenizing it. And so the numbers what I'm talking about, the good news is that the other than Yuma, the other segment is really growing pretty well for this year, and we'll continue to do that. This I've explained even in the past that our order book will continue to grow and will grow in the other sectors as well. So the absolute numbers are growing, and that's something which is very good for us.
But sir, in the nuclear defense, if you are assuming 200 crore worth of revenue this year, that's almost like doubling on an order book of 300 crore closing, roughly, which is like 60-70% execution. Is that doable in this business?
Yeah, it's a combination not only about nuclear defense space, it's also which includes the other segments of which I mentioned to you about the hydro projects that we are doing in clean energy segment, other than the Bloom projects. Like, for example, we are working with Hitachi, Andrix. Now we are looking at Void as well. And even GE Hydro has started working with us, and final negotiations are going on. So there's a lot of activity which is happening in the other segments as well. So if you put all those together, other than the Bloom Yuma units, I think that's the number what we are looking at right now.
As a generally, in your sense, given what the freight prices are, and we know that a lot of sheets comes from US as well to us. How you are looking this challenge is major Bloom is passing on all this cost element because their margins are very significantly under pressure there. So just in your sense, I understand that in the near term you have the inventory which you have been guiding from last quarter. But generally, in your view, can that impact the gross margins in near term, given what the freight rates are? And the employee cost has jumped up. Is it more related to hirings which has come up? If you can throw light on that as well. Thank you, sir.
Absolutely. See, the freight costs are very insignificant. If you look at, we are importing certain incoming sheets from Europe and as well as US. So sometimes because in spite of our inventory, what we are maintaining higher, the delay from the suppliers throughout the world, some of them are being airlifted as well. So Bloom is actually charging that to the supplier as well as Bloom is supporting us in terms of absorbing certain of this air freight and shipments, things like that. So I don't think that's going to be a factor, absolutely. It's a very negligible factor for us. And another important thing is with the bellows, what we have started manufacturing within India itself. That's something which US was manufacturing it before we are importing it. And now that's something which is localized completely. So that's a major achievement. Another kind of innovation and indigenization we have done in the clean energy segment, which I mentioned earlier in my whatever I spoke earlier. Employee benefit expenses, yes, absolutely right. See, it's important that we strongly believe in having the right talent ahead of time in the company. And we have an impact of about 1.2 to 1.4% on EBITDA to have the right talent ahead of time, especially with the new capabilities that we are doing. And we have done that ahead of time. And that's the kind of number you're looking at. It's an increase of 17 crores. So 5.5 6 crores is due to the new recruitment that we have done for the new capabilities to fuel the future growth, which is looking very encouraging for us right now. And we obviously have to plan that ahead of time. And partly others are towards the increments. And we all know that variable pay for our key employees is something which we have decided to do. That's another number which we are looking at, close to about 3 crores. For the kind of performance they have done, because we don't have at this point of time any kind of ESOPs for the employees. So at least we felt that they deserve the variable pay. Even moving forward, the kind of revenue growth we have, it makes a lot of sense. And this percentage, if you look at it, being 22% of the total revenue, should come down to about 15 to 16 or 17% in the current financial year. So that's something which is done to ensure that the future growth of revenue is covered with the right talent within the company.
Thank you, sir. I'll come back in the queue. Thanks for answering.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Good afternoon, sir. Sir, my first question is, of this target 500 crore of revenue, to continue with the previous participant question, can you clarify, what is the sales you are assuming from the clean energy segment?
So it should be, that's what I said, roughly the percentage should be about 60-40 as far as percentage is concerned. But if you look at the absolute number, that's a significant increase in the other sectors from, let's say, 120 crores to 200 crores, leaving the Yuma units aside. Even if you are doing a little sheet metal, all that put together would be about 200 crores. So that is something which I have mentioned earlier also. The other segments are, in terms of absolute numbers, are really picking up. And that's a significant sign that a lot of diversification in terms of the order booking and product mix is, in terms of absolute numbers, is changing, which is very good for the company. And also the kind of work we are doing for the clean energy segment. Today it is Bloom, but we are also looking at other customers under the sector, under fuel cell technology. And we are also working under clean energy with various customers in hydrogen, wind, etc. So a lot of diversified kind of work has been done to create this kind of situation in the current year. So that's something which is really encouraging for us.
So sheet metal, when you say, all those components also will be reported as a part of clean energy segment, am I right?
Yes, not totally. Probably some of them will also go into the aerospace sector as well. So we're working with NHL for that. We're going to have a few meetings next month, and we'll be starting on the. It's a sheet metal facility can handle both clean energy, aerospace, and defense sectors as well. So it's a combination of all the sectors.
And sir, the nuclear part of the business, how do you see execution in the current year?
Current year, probably, yeah, we're going to do it a lot more in the current year, right? So we're looking at almost close to about roughly around 80 to 90 crores of revenues coming from there, at least about 80 crores. That's where it's 200 crores, roughly what I'm talking about is a combination of nuclear, space, defense, and the other segments that we're working with, and some of the products that we're introducing. So that the nuclear also will grow every year consistently because of the kind of order booking we have done, and we are going to do in the current year as well. If you look at our order book of last year, FY22, it's at roughly 648, 650 crores. Now, already we had another 60 crores of order which we're supposed to get, we were declared L1, but we're getting the order right now. So more or less, we gave a guidance of 700 crores of closing order book. So domestic order book is also growing very well. And during the current year, we are looking at least about 800 to 850 crores of additional orders flowing in. So my analysis is that based on the kind of orders we receive, not only from clean energy, domestic, nuclear, defense and space and various sectors, clean energy sectors that we are working in a diversified way, we should end up around between 900 to 1,000 crores. I would say 1,000 crores would be the target number that we have in mind by end of this year.
You mean the closing order book?
Exactly, yeah.
Okay, because the 800 crores is order intake. So you are saying that from 640 crores opening order book, 800 crores order intake, execution will be roughly about 480 to 500 crores. That leaves closing order book of roughly 1,000 crores.
Exactly. Okay.
And the nuclear side, you talked about 80 to 90 crores execution. This execution is contingent upon, how sure you are about this, because, the progress at NPCI is quite slow at a point of time. So, is it going to be significantly back-ended, or, is it going to start from first quarter itself? Can you give some color on that?
No, it's going to start from, already we have these orders on hand. We have been working on these orders. That's why, the kind of platform we have created, if you look at the WIP, some of it is nuclear, space, and things like that. So these orders are already under execution right now. So when I say 80 to 90, it can even go up to 100. But at the end of the day, these orders are on hand with us right now. So there's nothing to worry about any delays from nuclear side of the portion. So I've also said that any new orders coming from nuclear, even moving forward for the current year, are not considered for execution this year. In spite of that, we are looking at that kind of a number which I've explained. So giving a revenue guidance of 55 to 60% overall is what we strongly feel is the right guidance, and we don't see any kind of downside to this for sure.
So this, the revenue from the nuclear side, what we are considering, normally the kind of product what we are supplying to nuclear power, is it at the last stage from the customer perspective, or is it like a ongoing thing from their perspective? Can you give some details on that?
It is an ongoing project that we are working right now, for which the revenue is going to get booked in the current year. For example, the cooling machine heads, the FP system, sealing and shielding coolant systems in the nuclear reactors for the Gorakhpur reactor. So all these are ongoing projects which we are working right now, revenues are being booked this year. So there is nothing of the orders to come in and then we have to procure the material. It is not, we have not considered any of those.
Understood. My last question is on the Bloom customer. You mentioned that there are a number of opportunities for this customer apart from the boxes. Would it be possible for you to share some details in the kind of opportunities, and by when you think you will start getting some traction on these opportunities?
See, first thing is, as you all are aware, we are doing the Yuma hot boxes for them in huge quantities. Now we are working on the electrolyzers. We are we got the prototype approved, and now we are doing the batch production of 60 numbers for that. Now, when this is going to ramp up, as and when we have more information, we'll update all our investors accordingly. That's going to be a very independent vertical, which will be as big as the UMA, but it will take time because a lot of infrastructure development throughout the world has to happen. So it will take time, but it will definitely happen. So we are in advanced stage there. Now, there are a lot of other products that we are working on in terms of import substitute. That's the fueling assembly which we are working on. That we have already submitted the prototypes to them for qualification. And I think mostly by June, we should be qualified for that. And with that, we are looking at that product itself, the kind of revenue that we can generate with a simple, very complicated, but for us, we have specialized it. We're looking at almost like 60 to 70 crores of revenues coming from that product itself. It will go into the product division of ours. And obviously, I've said we have cut down our costs drastically by manufacturing bellows in India instead of importing from the US. So these are the innovative things that we do every year. Another important aspect is the enclosures for the bloom boxes. We are submitting for qualification in another 3 to 4 days time from now. And once we are qualified, we have already received an order for about $3 million for the 700 roughly for these enclosures. And also for the sheet metal various assemblies also, we have been qualified. Already qualification process done, and we have received an order for $3 million there as well. The requirement for this is much larger. So this is just a starting point. So we have not really looked at all the incremental values that we'll get during the current year, but as of now, this is where we stand. But most important thing is the combination of manufacturing, sheet metal, all these aspects are used by fuel cell technology companies in a big way. So we have all kinds of, the idea is to integrate everything in one place. For example, if you take a hot box, reduce the logistics cost. To take the hot box and to assemble it in the enclosure along with the SM part, integrate it, and ultimately we're also looking at, as we mentioned, today the electronics manufacturing facilities that we're looking at will enable us to even integrate and become a fully integrated company for all the customers. So that's the goal which we have moving forward from FY24 onwards, so which we'll start implementing it from now on. Even for example, the new customers like IAI, Erita, Bluebird Aerospace Systems, all these, they look for total integration. That means you are looking at system level. You are not looking at the assembly level. So we are going to move into the system level itself moving forward in a year's time. And that's where you really take a company to a completely different level, and that's the kind of vision we have moving forward as well.
Sure. And sir, what are the typical payment terms with Bloom in terms of the receivables?
Can you repeat that question, Rajesh?
What are the typical, receivable terms, with Bloom customer?
See, we have 45 days net after receiving the material to their warehouse in Delaware. So that's what that includes. We have to add the transit time, which is getting a little delayed. But if you look at the track record which is available, absolutely there has been no delay in any payments from Bloom till date. They've always been paid on time.
Okay, perfect. Great, sir. Wish you all the best. I'll come back in queue. Thank you.
Thank you, Rajesh. Yeah.
Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good morning, sir.
Good morning, Sandeep.
Sir, first question is on Bloom Energy part. If you can spend like a couple of minutes on each of these sub-items, how you're looking at the volumes. Say for Yuma and Key Loco, the main hot boxes, what kind of volumes you are likely to do. I think the 4,000 box guidance was for Yuma for FY23. What can be the addition from Key Loco? And then separately, if you can guide for, say, electrolyzers, the FRUs, the hydrogen boxes and sheet metal, maybe a couple of minutes on each will just help us understand this growth story better.
Yeah, sure, Sandeep. See, basically, when I said Yuma of 4,000, it is actually 4,000, I think 4,100 or 200 units. This is from
4121.
Yeah, 4121. Okay, thanks, sir. Yeah.
So basically, this starts from January to December. Sandeep, you are aware of that, right? So it's a calendar year order that they place. Now, this is on track, so there's no issue with that. So the next calendar year, they will look at in the month of July to look at the kind of boxes they're going to order for next year, which is going to be definitely much higher than this number. So effectively, the January to March of next year order, as far as our financial year is concerned, that number could be slightly higher, obviously, because of the increased quantities required by them. That's the kind of forecast they've given us. So this 4,100 can be higher than what we're looking at right now. So we need to look at that once we receive the final numbers from them. But it is on the upside. There is no downside to this. As far as, so Sandeep, you understood this, or can I go to the next point?
Yes, please, sir.
So the Kilaco, we have done the first 30 numbers. We have dispatched them already in the fourth quarter of this last year. Another 10 numbers we are dispatching in this quarter. We have all the prototypes of Kilacos that we have manufactured. They have received, they have airlifted a few of the Kilacos to just quickly check on the qualification process, and they came back with excellent feedback about the quality because we are doing this for the first time, and they are very much satisfied with what we have done in terms of Kilaco. Now, this Kilaco process will start from second half of this year. That's what they've mentioned us, and the kind of numbers they're looking at, you'll come to know in the month of July, but they said to gear up for that from second half of this year. So I'm not looking at a great number of Kilaco because Yuma volumes are on the surge on the higher side, but Kilaco will add into those quantities during the second half of the year. So we have not considered those numbers in our plan right now. So as and when they come in, we'll update certain guidances accordingly.
Sure.
Electrolyzers, you have any questions on Kilaco, Sandeep?
No, sir. I think just one on realization. Is it disproportionately higher than Yuma, or it is too early to comment on that?
It is definitely higher than Yuma. There are two reasons for that. Obviously, you know that the output is 1/3 more than Yuma. Obviously, the inputs and the assembly costs are definitely higher. It averages between 18,000 to 20,000 in volume business. Right now, we are doing the prototypes at 23,000, but it will stabilize at between 18 to 20,000 based on various innovations and integrations which we'll do over the next 1-2 years. So definitely almost double that of Yuma.
Got it.
Then moving on to electrolyzers, this is an area or a subject for the future. So we have done the prototype, successfully done it. Now we are doing the batch production engineering. As I always told all of you that we have to do batch production, we are doing. And this is something which we are looking forward in a big way in FY24. So once the batch production is done in this quarter and the next quarter, then they would probably release another batch production. But the real surge in numbers from electrolyzers would come from FY24. This is a clear information I received from you. And they're also very excited about this. There's a lot of infrastructure requirements which are being developed across the world for green hydrogen, which I've said very clearly, it is not the most important thing is to focus on technology rather than talking about any competition here. So there is huge space for this available. And this vertical, we are really looking forward to it from FY24 in a very big way, which can be even bigger than Yuma and Kilaco itself. But this will treat it separately, independently as an independent vertical, which will grow bigger and bigger as time passes by. So probably the surge will happen in FY24 for sure. So that's where we stand in terms of electrolyzers and hydrogen units both. So they're similar. One is hydrogen units, you feed the hydrogen, and electrolyzers you feed the steam to get green hydrogen. In hydrogen units, you feed hydrogen, but it is not green, but it is grey hydrogen. So that's what both are in combination to each other.
Understood.
The good news about sheet metal is we have received we are qualified for the assembled parts of the sheet metal for Bloom. They have given us 67 assemblies. We are qualified for all the 67. Now the Adipatla sheet metal plant is fully in operational. That is another good news. We are able to establish the process consistently for them. and now they've also released a production order for about close to about, I think, $2 million plus. So once we do this production order, they will ramp it up and increase it during the course of the year. So that is something which is going to grow in much larger numbers, which we'll be able to update all of you probably in the month of July at the end of the first quarter. The next area is the enclosures. The important thing here is they've asked us to make the enclosures 3 numbers. We have done the essays. Right now they are under qualification process or inspection. If you have all seen in the internet, the bloom boxes, the outside casing is a very critical thing for them, which has to be very aesthetic with specialized powder coating and things like that. We have all that in place. Now, these enclosures will be equivalent to the number of boxes that we make. So this is something which they've also given an order for 700 numbers of enclosures post the qualification. So this order will be executing in the next quarter, Q2 of this year, more or less. And then the ramp up will start even in the enclosures step by step. So this is an area where we are also looking at equal number of units, whether it is Kelaco or Yuma or electrolyzers. They all need these enclosures and some parts. So that is a major advantage that we have. Another important thing which I explained earlier is even Bloom wants to integrate everything. When I look at electronic manufacturing facilities, it is not much of a capex required, about 25 to 30 crores. In the long run, we can start in a phased manner. The hot boxes will go into the enclosures and also the SM parts with fully integrated electronic systems, which right now they are doing elsewhere, will enable Bloom to have the logistics cost coming down drastically, and which will also help MTAR to actually increase our value add to Bloom in a big way. So that is the plan moving forward. Now, we're not only depending on Bloom in the case of electronics. I visited Israel. I was there for 1 week last week. And even ELTA, all of them are interested to work with MTAR, and they're all visiting next week here in a big way, both on the electronic side and as well as on the assemblies. And so ultimately, we're looking at a system-level approach year from now. So that is what we are planning in terms of associating with big OEM MNCs and working in system-level Make in India concept for the various organizations, defense organizations in India, which is become more critical now because of the Ukraine-Russia war. India wants to be more independent of that situation moving forward for the next 2-3 years. So that's the kind of vision in which we are trying to move forward.
Understood, sir. This is very clear. And I just wanted to add one more question to that was the market share between us and the Taiwanese supplier. You mentioned from 50-50, it was moving in the direction of 80-20. So where have we closed last calendar year, if you can give some sense, and from the current calendar year, where that share can be between us and the Taiwanese supplier?
I think it's now 70-30. We all know that 70-30 is what I know for sure. So probably with this new innovation of bellows being done by us, the way they're executing it on time, with zero remarks on quality, obviously they will still continue with them because they will not go down below 20 for sure. So probably we might move into an 80-20 ratio. We will know that in the month of July for sure. So.
Okay. And last question is on the nuclear power segment. We had guided that these 3 orders will get ordered out on bulk basis by NPCIL. But some of the companies have been highlighting that after those 3 projects, 1 is getting tendered and 2 might get re-tendered. So from a future order inflow perspective, how should we look at the annual inflow within nuclear power? Or is there a significant delay we should be worried about?
I don't think we need to really worry about anything. See, even if you look at our current year plan, the annual operating plan for this year, whatever order book we have on hand is getting executed, and all these orders are going for FY24. So there's no issue absolutely at all. And frankly, with the new CMD coming in, he is a little bit more aggressive in trying to execute these orders much faster in terms of implementation of the nuclear reactors. We also got instructions that they need to move very fast in terms of implementing the nuclear reactors moving forward as well. Because these are all indigenized reactors. Where in case of Kudamkulam, it's Russian reactors, so They would like to have this pressurized heavy water reactors, which we have indigenized 100%, working on that for the last 50 years, to move in that direction very aggressively and become very independent of the outside world. So this is going to move in a much faster pace going forward.
Okay. Got it. Thank you so much, sir, for taking my questions.
Thank you, sir.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Santosh Yelapo from Asian Market Securities. Please go ahead.
Thank you for the opportunity. I had 3 questions. First thing, sir, I'd just like to get a sense for the kind of FY23 revenue guidance we're giving. How confident, even though this question has been asked, but I'm just trying to still get some comfort.
Santosh, yeah. So, as you're all aware by now, so whatever guidance we have been giving, even in the last year, we have never gone down on the guidance, but we have revised our guidance slightly upwards at the later part of the year. So, based on what we have today and the way things are moving, in terms of the supply chain, in terms of the order book, in terms of the kind of various requirements that are coming up. So, in fact, I had given a guidance of 45 to 50% last quarter, but we had a detailed review over the last couple of months, and we are pretty confident of that 55 to 60% revenue guidance moving forward. No issue with that.
So you're assuming that there will be no supply, raw material supply shocks going forward in any scenario?
Yes, we have planned it very well for this year as well. We have done a lot of effort and work towards that, as our CFO has also mentioned to all of you. So we don't see any kind of hiccups going forward as well for this year.
Okay, great, sir. Sir, also the acquisition that we did, what kind of capabilities it brings for MTAR? Is it in terms of addition of new programs, or is it in terms of new clients? I understand. So how does it gel with the growth or long-term growth prospects of the company?
See, the first thing is let me explain this in more detail since I didn't have the opportunity to do it before very quickly. See, GP Aerospace is an MSME with very good set of machinery and infrastructure what they have. So what the company has done is we got it at a very good price for a company which is already registered as an MSME with a lot of other different companies, whether it is ASL, HAL or any other company, they're already there. So normally MSMEs have certain benefits and with the help of MTAR, the subsidiary would do extremely well in accessing such orders from different companies where MSMEs can have a price advantage for certain kind of orders. Obviously, the other highly technical orders, obviously MTAR looks into it. The second reason is there's a lot of work that MTAR itself can support this subsidiary in a big way because they have certain machines which they can fully utilize. And they also have trained manpower there, which can also add a few more people. It makes sense. The third reason is the defense offset clauses for the OEMs, for the MNCs. For MSME, they get a 1.5 multiplier. And plus, it also helps us to associate with certain MNCs in terms of joint bidding in the future for the major projects, having a separate subsidiary with the overall support of MTAR. So there are a lot of advantages we have realized there, and by end of this month or beginning of next month, we are going to close it out and start quickly ramping up that particular MSME, which would also help MTAR in a big way.
Okay. So lastly, one small question. What all have been the new clients which have passed the qualification criteria stage in the last 6 to 9 months? You have referred a few names, but I just want to get a more sense how many of them and from which segments they are.
See, we have done with Worldwide is one which they buy a lot of specialized ball screws for us. Now they've already passed that stage of executing orders with us. Hitachi is another company. Bentel is another company. ARD, DMD, they've already started receiving orders for the valves. Now we are working with Enercon for the new project that they're looking at for the windmills. That we are going to work in a big way. GE Hydro has already approved our facility. for the huge requirements they have. In fact, our team is visiting them next week to close out a lot of orders with them as well. So the other companies are in a stage of pre-qualification to qualification. So probably by Q2, we'll be adding a lot more customers in terms of III, RITA, and companies like that. So we are looking at, it is not about number of customers, but the kind of quality customers that we have, and that's what we're looking at. And step by step, I think we'll have a much larger basket of these customers. And that's why it is enabling us to have that kind of a number on the domestic front, which I explained even earlier.
Okay. Sir, my intention of asking the question was that I'm just trying to roughly gauge when you're doing your FY23 projections internally. Do you foresee a scenario where these new clients having passed the qualification criteria to end up with somewhere around 100 to 120 crores kind of a top line for FY23?
Yeah, we have done that. For example, Voice, we have passed that situation. Hitachi, we have passed that. Andrix, we have passed that. Bentel, we have passed that. So we have a lot of companies we have passed that stage and executing the orders right now. So that is the reason why, combination of all these, that's why the number other than Yuma boxes is on a much higher side, almost doubling up. So that's the major advantage.
And sir, lastly, if one looks at the FY22 revenue mix and the guidance for FY23, I think in FY22, clean energy was 64%, and you are expecting 60% of the revenues in FY23 to come from the clean energy side. So how should one read into the margin profile going forward, having that this year we have seen almost a 400 bps decline YOY?
See, I have said about the margins, Santosh. It's always better to be conservative. So I've said it will hold around 30% EBITDA margins even for the current financial year. And there are a lot of things which can improve because your numbers on the domestic front are improving almost from 120 to 200 level. Secondly, we have invested a lot on the talent within the company way ahead of time, so that employee benefit expense in terms of percentage of revenue would come down over the current year. So let's see how it goes. But as far as we are concerned, normally we give a guidance which we are little comfortable, very comfortable with. Probably it can even improve definitely beyond that, but we will still stick to the guidance what we have given in terms of margins.
And just to continue the same point, sir, for FY24, given that we are investing now on new hirings, and when scale kicks in big way, do we see a big operating leverage advantage kicking in FY24 that, a 30% EBITDA margin guidance could move to around 35-37% levels in FY24? That would be my last question.
Yeah, see, look, at the end of the day, how FY24 pans out, I really don't know at this time, but definitely the kind of revenue growth and outlook we are having, obviously, we are not in a company where we are increasing our revenue and compromising on our margins, right? So a lot of overheads get absorbed as when the revenues go up, and obviously the margins should improve better and better. So let's address that once this year is done and probably do better than what we are saying today and then move forward. Obviously, the revenue growth will be more or less, hopefully more or less similar to what we have today, and we'll be right at it.
Thank you, sir.
Thank you very much. The next question is from the line of Deepak Nonoria from Aditya Birla Sun Life. Please go ahead.
Yeah, hello, sir.
Good morning.
Yeah, good morning, sir. Thanks for giving me the opportunity and congratulations for good set of numbers. One question is partly answered actually, just the previous, you were actually talking about this only, about your margins. So actually, sir, this year you have delivered 30% margin, and which is down from 33-34% margin in FY22. And as far as I remember, I had a meeting with you 6 months back only. At that time, you were mentioning that yes, margins will definitely improve, and I was expecting somewhere around a 33% kind of margin for the year. So is there anything which has gone wrong in comparison to your expectation, or you are guiding for a very strong growth? So are you being conservative when you are talking 31%? Because earlier you had been aggressive on this front, that yes, you can outperform this maybe somewhere around 33-34%. Exact number I don't remember whether you mentioned or not, but that was the sense I was getting.
No, actually, if you look at it, I have clearly mentioned in the last quarter itself that we're looking at around 30% of EBITDA levels. The reason being, as I said, I've explained this earlier, that around 1.5 percentage points has gone into the employee benefit expenses, looking at the future outlook that we have in terms of revenue growth. So that's the kind of investment we have done, which is being written off in terms of getting in those talents well ahead.
1.5% of sales, you are saying?
No.
Yes.
I'm talking about the overall EBITDA. We have spent about 5.5 crores purely on talent recruitment for the future growth ahead of time. You can't get the right talent in the last minute. So we have genuinely done that. That was an outflow of about 5 crores.
You spent on what, sir? 5.5 crore spent on what?
That's the spent amount of money which has been spent on the employees who we have recruited for our new capabilities for the future growth ahead of time. That's the investment we have made, which is very important. It's not about CapEx, but also the people behind the machines and the systems are also very important. We strongly believe in that. To have the future, so the same, if you look at the employee benefit expenses, moving forward from 22 might come down to about 15 to 17%. So you are right in what you're saying, and normally I would like to say, if I'm saying moving current year also we'll do 30%, probably we might do much better than that, but it's always better to stick to a number which we can probably, closing our eyes, we'll be able to achieve, and then do better, and it is always better. That's what I strongly believe in. So this is the reason for that, and I clearly mentioned about this even in the last earnings call as well. So in terms of revenue increase and as well as the EBITDA margin.
And sir, this actually your RM to sales has increased to 36% this year. So last 3 years it has been in the range of 32 to 34%. So what kind of level it will be?
No, it all depends on the product mix, what we are doing. Now, since this year we'll be doing close to about 200 crores of other segmental revenues from 120 crores and all. So probably that's another additional major benefit that this company is going to have. So a lot of things are moving in the right direction to improve the margins better and better. So what we are doing is that we are spending certain money in terms of R&D, in terms of employee benefit expenses, to fuel the future growth in the right direction. So the benefit can be seen more and more in a better way moving forward. So that's exactly where we are today, and we'll continue to do that.
Okay. And sir, apart from this, one more question I have. This is about your working capital. So you have been mentioning that you have built up inventories in anticipating the increase in raw material cost, spike in commodities. So, but sir, still your receivables has also increased significantly, and your payables have gone down. So this has really impacted your working capital. So if you can throw some light on that.
See, I'll briefly tell you, and probably CFO can also explain that. See, the important thing is none of our receivables are, of any issue. We have always received them on time. Where the government receivables, we have done major shipments in the month of March as well. So none of our receivables have gone back till today. We are all dealing with very reputed companies, and all the monies will come in. Probably you'll see a change probably by end of this quarter with all the receivables already coming in. So none of our debtors are any issue at all. We are working in a very niche area with great client base, so we never had those issues at all. So probably that you are seeing a surge which will obviously come down moving forward, and as when the revenues are going up, obviously we'll see that as well. And secondly, on the raw material front, we are not really concerned. Actually, the company is benefiting from it vis-a-vis towards the interest cost, marginal interest cost, what we are paying or with our internal accrual. Today, if you do a spot buy of any raw material, it is 30 to 40% higher, and it's ridiculous. So we have planned this way ahead of time. Like last year, we anticipated. Fortunately, we have anticipated even for this year that things might continue in a similar manner and stabilize probably 6 months from now, or by end of December. So that's the reason why we are doing this, which actually has helped the company more than anything else, keeping our production lines very active throughout and also not getting really affected by the raw material surges what are happening today. So that's exactly what I'm trying to say.
Yeah, sir, raw material is okay, but your receivables have also, in number of days terms, it has gone up by somewhere around 40 days YOY. So if there is something,
no, that's because we have done a lot of shipments to Bloom. We have done a lot of projects in the month of March to MPCL. All those receivables are coming in now. So probably we can give you the age. I think the CFO can give you the age-wise analysis of receivables as well.
Okay.
For you to understand it better. No issue at all.
So if I have to comment on so if I have to comment on that receivable, 95% of the receivables are not overdue. So all are current only. So because of the customer, the receivables are the higher. Like most of the sales are export sales in the last quarter. So that is the reason. Otherwise, the receivables are no bad debts. Nothing is concern. Area of concern is the receivable.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Thanks for the opportunity, sir. So I joined the call a little late. Could you give the sense for CapEx in FY23 and going forward?
See, FY23 we're still implementing those Adipatla projects in the fabrication area. So that's the same CapEx that we're using there. Apart from that, we do have certain. Every year we look at 15 crores and or 10 to 15 crores areas where we need to look at based on the next year growth that we have in bottleneck areas. We already mentioned to all of you that we're looking at about 40 crores and not for the Bloom expansion plan, which we did discuss in the last quarter itself. And other than this, we're also looking at electronics manufacturing facility, about 25 to 30 crores. Around that, we have not crystallized the numbers as of now, but to become a system integrator on the system level itself. So these are rough numbers that we're looking at right now, but we have enough. Apart from this, for this year, we will not have further plans on this.
Okay, that's great. So regarding nuclear power, so I think European Union has a lot of trust. France, Germany, all these countries have a lot of trust on nuclear power going forward, and considering the erratic supply of gas from Russia as well. So are we seeing any opportunities over there, or are we already supplying to them?
We are not yet supplying to them, but there will be opportunities coming moving forward, because forget Germany and France, even in India, there has been a sudden, surge of speeding up the implementation of all reactors within the country itself. So we will have enough on our plate to handle that as it is. So further opportunities come from abroad for their technology. Obviously, we are there to work with them. So let's see how it goes.
Okay. And so on the working capital side, so suppose we get a project, and how much advance do we take for as a percentage of the total project cost, or can you give a sense of that from the customer?
GR, you want to answer that?
Yeah. Actually, this advance from customers is there only in the case of domestic customer. We have different terms with the customer. Like, when at the time of order, 5% they will give. After submission of engineering documents, they will give another 5%. Then after receipt of the raw material, another 10%, like this. So almost 30% of the domestic revenue, domestic order value, we may receive from the customer to customer. It is more or less whatever I told you. This is what in this pattern there are the big supplies.
Okay, that's great. And also you told that we don't have any bad debts and our working cap, our receivables are really good. So can we look at any factoring arrangements, to reduce these working capital days?
Actually, see, the bill discounting factoring, even if we do, it will not go off my balance sheet because recourse, all the banks in India, they do only recourse factoring. Non-recourse factoring is only the foreign banks will do, but we are exploring on that to take out from my balance sheet, but it will take some time because it is based on the customer and the foreign banks' willingness to do the factoring and all. So non-recourse factoring, which is I think not happening in India, but we are exploring with some of the banks in future, like Japanese banks and some other banks. We will try and do the non-recourse factoring.
Yeah, that would be great. And lastly, what would be the percentage of sales for our R&D expenditure?
No, it's not percentage of sales. Basically, we spend as said earlier also. It depends on year to year. Normally, roughly around 4 to 5 crores or 6 crores of funds that we utilize. But we also use a lot of our existing facilities for that. So we do a lot of R&D and innovations every year. But that's how we do it. So it depends on the need and how much we need to do year-on-year basis.
Okay. That's great. And that's it from my side. All the best. Thank you.
Thank you.
So one thing I just want to add, someone asked about the capex for FY23. The Bloom expansion, I think we need to add to that.
Yeah, I have mentioned that. Yeah.
Okay.
Thank you. The next question is from the line of Pradyumna Chaudhary from JM Financial. Please go ahead.
Hi, sir. Good afternoon. So I just wanted to understand regarding Bloom, are we still reducing the final product prices for our customer? And if yes, at what rate was this in FY22? Like, what was the average? How much was the average realization down by in the year gone by? And overall, how are we managing the cost? Mainly through volume increases. That's all from my.
So we already have an order till December, and every year we never reduce the price based on volume. It's only based on innovation, I've mentioned very clearly. But we still try to maintain our margins every time. So we'll continue to do that moving forward as well. So there's no question of reducing the price based on the volume because we have crossed that stage and we're only looking at any cost reductions which happen through innovation where company gets benefited and partly Bloom. So that's how we work. Other than that, this should not be an issue.
Okay. Understood.
Pradyumna, do you have any follow-up question?
No, that's all.
Thank you. As there are no further questions, I now hand the conference over to Mr. Srinivas Reddy for closing comments.
Yeah. I would like to thank all of you for sparing your time to attend our earnings call. And we have given a guidance last year and we adhere to such guidances. We reiterate again for this year that as far as our margins or revenue guidance we have given now, obviously we have done it with a lot of thought process and we're very careful in doing that. And we'll continue to work towards it and achieve whatever we have mentioned. And we will obviously be in touch quarter-on-quarter basis to take further updates from the company. And that's it. So thank you so much.
Thank you very much. On behalf of participants, in case you have any further questions, you may write to irfan.rain@lincolntime.co.in. On behalf of MTAR Technologies Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.